Well, Himanshu, it's really nice to see you again. Gosh, it's been 6 months or so since I was last in India seeing you, and here we are working remotely together now. Well,
Absolutely.
well, you lead the international tax practice for KPMG in India, and you've been telling me just about some of the big things that are going on in the field of tax. Tell me a bit more about those.
So Rodney, there are quite a few interesting developments which have happened in India in recent times as far as MNCs are concerned. There are three interesting topics that I would like to talk to you about. The first one is in the context of introduction or rather expansion of a tax, what we call as an equalization levy, which is India's digital tax, which has been significantly expanded in its scope and purview. The second interesting development which has happened is a sea change in the taxation of dividends declared by an Indian company to its shareholders. The third important announcement which has been made by the government is in the context of a new tax dispute resolution scheme which has been announced. So these are three recent developments which have happened, and happy to talk to you about those.
Great. Well, that sounds fantastic. So let's start. Those are three big topics that, gosh, when I talk to my clients around the world, three topics that are always top of their mind when they're thinking about India. So yes, let's.
Perfect. So let's start with equalization levy. As I mentioned earlier, equalization levy is sort of India's digital tax. This levy was introduced in India for the first time in 2016. At that point in time, the levy applied only to online placement of advertisements. However, effective April 2020, this levy has been significantly expanded and covers several other transactions within its purview. So the expanded version of the levy, as it now stands, applies to any online sale of goods or online provision of services or online sale of goods or provision of services being facilitated by a non-resident e-commerce operator to an Indian resident or to a person using an IP address located in India. So you see, the scope of this levy is extremely wide in its coverage. It covers any online sale of goods by a non-resident e-commerce operator, any online provision of service by a non-resident e-commerce operator, or any facilitation in respect of online sale of goods or online provision of services by a non-resident e-commerce operator, where the beneficiary of this is either an Indian resident or a person who has an Indian IP address at the time he makes the transaction for purchase of goods or avails services from the non-resident e-commerce operator. So you will appreciate that the scope of this levy is extremely wide in its nature. Not only does it cover digital goods within its purview, it also covers physical goods. So assuming if there's an online sale pertaining to physical goods which happens, and if the goods are delivered offline, even those transactions get covered within the purview of equalization levy. As far as this expanded levy is concerned, the levy is applicable at the rate of 2% of the amount of consideration paid by the buyer of the goods or the service recipient to the non-resident, and the levy is to be discharged by the non-resident e-commerce operator who needs to obtain a tax registration in India and discharge the levy in quarterly installments every year. In fact, the levy not only applies for all these transactions which happen between a non-resident e-commerce operator and an Indian resident. In certain circumstances, it also applies to transactions between two non-residents. So you can just imagine how wide the levy is in its coverage. Now, there are quite a few ambiguities which have arisen as a result of the expansion of the levy. So, for example, what happens in a case where an order is placed online but the goods are delivered offline? Can it be said that the sale has concluded online, or can it be said that merely the order has been placed online, the sale gets concluded when the title to the property in the goods passes? And if the title passes, offline and not online, can it be argued that the levy should not apply in a case like this? That is one big issue which merits consideration. Issue number two, what about cases involving online orders being placed through emails or a ERP platform? Would that be wide enough to be subject to equalization levy? The law is not clear on that. What about provision of intra-group services or management cross charges? What would happen in a scenario if the services are provided offline, but they are transmitted online, or the delivery of or the deliverable is sent online? Whether equalization levy would apply in a case like that or not, that's a little nebulous. Now, a lot of representations were made to the government from time to time with a request for the government to issue some clarifications in this regard. But the government does not seem to be inclined to issue any clarifications. With the only option now that the taxpayers are left with is to take their own independent positions on the subject matter and decide whether to discharge their liability or not. So that's something about equalization levy.
Gosh, so that's a potentially significant cash flow cost, and it's in place as we speak today, Himanshu?
Yes, it's become effective on April 2020, April 1, 2020. So it's already effective.
Okay, so it's already effective. So gosh, for those folk that haven't been evaluating this is something they really need to look at, because it sounds like the width of it could be a lot wider than normal digital services taxes around the world.
Absolutely, absolutely. And therefore it would be advisable for all our non-resident clients, all foreign companies, MNCs, to have a close look at the scope of equalization levy and consider whether it would be applicable in their case or not, and then take appropriate positions there.
Got it. Fascinating. And then you were talking about the change to taxation of dividends.
Yes. So what's happened, Rodney, is that, again, effective April 2020, we have witnessed a paradigm shift in the tax regime pertaining to dividends. Until the last fiscal year, as far as taxation of dividends is concerned, the Indian company declaring dividends was subject to a 20% tax known as dividend distribution tax. Now that is very unusual, because globally you find that the shareholder is subject to tax in the dividends and not the company declaring dividends. But in India, ever since the year 1997, we've had this regime whereby the incidence of taxation shifted from the shareholder to the company declaring dividends. However, effective April 2020, the incidence of tax has now moved back to the shareholder. Therefore, the company declaring dividend will not be subject to this 20% tax. Instead, the shareholders will be subject to tax on this dividend which they earn from the Indian company. And to my mind, these are two major advantages as far as foreign shareholders or non-resident shareholders are concerned. The first biggest advantage from their perspective is that they'll now be entitled to the benefits of lower taxation under tax treaties which India has entered into with several countries. So if the shareholder happens to be from a treaty country, he will have the benefit of lower withholding tax on dividends as compared to the typical 20% tax rate under the Indian domestic tax law. He can avail of the benefits of treaty, and you will find under treaties the rate of tax on dividends varies or ranges anywhere from between 5% to 15%. So that's a significant tax saving as far as shareholders are concerned. The second advantage is that under the DDT regime, the erstwhile regime, there's a big question mark on whether the shareholder would be entitled to a credit of the taxes paid by the Indian company. Now, since the incidence of tax has shifted to the shareholder will be in a position to claim a credit of the Indian taxes against the liability which the shareholder will have in its home country. So two major advantages of this new regime as far as shareholders are concerned. Having said which, shareholders will need to be mindful that if they need to claim any treaty benefits, they'll have to fulfill certain conditions. Number one, they'll need to obtain a tax residency certificate from the country where they are located to justify that they are tax residents from that country. Condition number two, the shareholders will have to demonstrate that they are the beneficial owner of this dividend so as to be entitled to the lower rate of tax under Article 10 of the tax treaties. And in cases where investment has been made into India through an intermediate jurisdiction, there will be an additional burden to be discharged of satisfying whether the case of treaty benefit falls foul as a result of the principal purpose test or the Indian GAR provisions, the general anti-avoidance rules provisions. So one will need to satisfy even the PPT and Indian GAR provisions before claiming treaty benefits. Subject to fulfillment of these conditions, I think this is a very good development as far as non-resident shareholders who made investments in India are concerned.
Well, no, sounds fantastic. Certainly some gates to get through in terms of technical analysis, but the hope for outcome, a reduced rate of tax on profit extraction, which is just a great thing.
Yes,
absolutely. Yes. And then Himanshu, you were also telling me about the approach to tax disputes. Yeah.
Yes. So again, a very welcome development from an Indian standpoint. India has made an announcement of a tax dispute resolution scheme, which has been introduced with a view to bring all past tax disputes to an end. Just in terms of statistics, in India, we've had almost 500,000 cases which have been locked up in litigation across different levels of appellate forums and courts. And I'm just talking about income tax cases. I'm not talking about indirect tax cases, 500,000 number of cases. And the amount involved in dispute, the amount of tax involved in dispute is close to $125 billion. So that was the magnitude of the problem that we are dealing with. And in that context, the government announced a dispute resolution scheme, which I think is a very, very interesting scheme as far as taxpayers are concerned. And it applies not only to Indian taxpayers, but even overseas taxpayers who have been embroiled in tax litigation in India. So just to give you a little bit of perspective on this scheme can be taken advantage of by any taxpayer, provided he has an existing tax dispute as of January 31, 2020. So if there's an existing tax dispute as of that date, then the taxpayer can avail of this scheme. And now the way it works is, in terms of the amount payable by the taxpayer under this scheme, the taxpayer will end up paying either 50% of the disputed tax liability or 100% of the disputed tax liability with a complete waiver of interest, penalty, and no risk of prosecution whatsoever. So the taxpayer would end up paying 50% provided if the taxpayer has succeeded in an appeal before the lower appellate authority, and if the revenue has challenged the matter before the higher appellate authority, then the taxpayer needs to pay only 50% of the disputed tax liability. But in a case where the taxpayer has lost in an appeal before the lower authority, and the taxpayer has appealed the decision of the lower authority before the higher authority, then the taxpayer needs to pay 100% of the tax liability. Now, we've had disputes in India, which are 5 years old, 10 years old, 15 years old. And if you work out the amount of interest on that disputed tax, it will far exceed the amount of tax itself. So the waiver on interest and penalty and doing away with the risk of prosecution itself, to my mind, I think that gives a significant advantage to taxpayers to go for this scheme. And when you compute this tax liability in dollar terms, given the significant depreciation of the Indian rupee against the US dollar over the last 5 years, 10 years, 15 years, in dollar terms, the liability will be much lower again as compared to what you would work out in equivalent rupee terms. So I think again a very, very welcome scheme which has been announced by the government. Taxpayers have got time up to December 31 this year to take the benefit of scheme and bring their past disputes to an end.
Okay, but there's a time limit, December 31, to get in the program.
Yes.
So just fascinating, Himanshu, just a lot of stuff going on for folk that are conducting business in India. First of all, the opportunity to clear up old disputes. Second, the opportunity to reduce the cost of profit extraction. Welcome sign. But then the equalization levy on the other side, which may just be incredibly wide, and people really need to get focused on that because that exists right today. Well, Himanshu, lots to talk about. So thank you for your time. It certainly was a pleasure catching up with you again, and just lots to think about. So thank you.
Thank you, Rodney. It was a pleasure talking to you. Have a good day.
You too.